Welcome to another episode. My name's Jose Najarro, and today we're going to take a look at FIZZ. This is National Beverage Corporation. We're going to take a look at Q1 earnings for 2020. Like always, I have my buddies Bull Solo and Darth Bear ready to keep track to see how the company is doing. So let's get started. Before we begin, I just want to let you guys know where I got all the information. So the information was taken from FIZZ Investors website, and there I took a look at the 10Q report and the 10K report, so the annual and quarterly report. I also used the website Seeking Alpha to look at any other information that I might have missed from the 10Q or 10K report. So right off the bat, FIZZ is a pretty small company compared to all the other companies I have taken a look at. So right off the bat, I just want to start off with who is FIZZ. So FIZZ is a beverage company. They do beverage gears to the active and health conscious consumers through their Power Plus brands. They also have sparkling waters, energy drinks, and juices. Right here I took an image of some of their product lines. They also produce and distribute carbonated soft drinks, including Shasta and Faygo, and their primary market focuses in the United States and Canada. Right here we can see they do have a lot of carbonated soft drinks. They also have a lot of 100% juices, energy drinks, and shots, and sparkling water products, as well as some other power brand items. And we can see some of them here. All right, so the first main thing we're going to take a look at is revenue. We're going to take a look at their most recent earnings, which was Q1. Earnings per share of 74 cents, which missed by 1 penny. Then they had revenue of $263 million, which is down about 10% year to year. And it was a miss by about $10 million. So because of the miss in both earnings per share and revenue surprise, I'm going to start off the first point to Darth Bear. Next, we're going to take a look at comparable sales. So like I mentioned in the previous slide, they did see a net sales decrease of about 10%. What did this net sales decrease of 10% mean? It means that they lost about $30 million year to year compared to the same quarter last year, and they lost a net income of $14 million. So here I took this from the I think this was from their investor slideshow, and here we can see July 28, 2018 compared to July 27, 2019. And we can see we have lower net sales, lower net income, lower earnings per share. So one thing to note is that their net sales went down by 9.9%, but the decrease in sales resulted primarily from a 10.6% decrease in case volume. So what does that mean? That means that they actually sold about 10.6% less items that they did a same year ago. And the reasons that net sales and volume sales does not match is that they usually have, as the years go on, they have higher selling price, and here they can tell you offset in part by higher average selling price. So even though they sold 10.6% less drinks, net sales only went down by 9.9%, but that's because they did increase the volume of their drinks. The volume decrease includes a 16.2% decline of their power brand products, and it was partially offset by 3.6% growth in carbonated soft drinks. So that's a huge number. You definitely do not want to see a number like that when you're talking about decline in sales. 16.2% from year to year is a huge decline to see, especially in one product alone. The reduction in Power Plus brands volumes was due to the increased competition within the sparkling water category, which I'm pretty sure Pepsi or like Coca-Cola, one of those big brands, has just entered, and we can see they are definitely taking a toll with that decrease of 16.2%. And like we did mention, average selling price per case increased about by 1% due to a previous price increase as a result of increase in aluminum costs. All right, so here we're gonna have to give another point to Darth Bear, and the reason is simple, right? This company has a decline in net sales compared to the same time last year. They have a net income decrease. They have almost a 10% down in net sales. They are selling less cases. They sold about 10.6% less volume. Their power brand was down 16.2%, and they are seeing a huge competition increase in the sparkling water system. So another point for Darth Bear. Some things to note, right? The cost of sales per case increased about 2.1% this quarter, and that means that they're right. The cost of sales means that either the materials they are using has increased. And as a result, gross margin declined to 36.6% from 39.5% same time last year. So going down almost 300 basis points is not a good thing either. That's something that investors should keep an eye out. The next thing is more of a personal opinion. I'm not a fan of their 10Q report. So there's many reasons why I'm not a fan of their 10Q report. The first reason is I know this is a smaller company, but I feel like their 10Q report was done by someone that just came out of school. It's pretty limited amount of data. They referenced the 10K report numerous times. So the 10K report is the annual report and the 10Q report is the quarter report. So they do reference the 10K report. So I had to look back and forth when doing this, and most big companies actually put the information that they posted in their 10K report into the 10Q report, so one doesn't have to do that. So that's something I'm not a fan on. And yeah, very limited on the data they provide. For example, they do not have a breakdown of how much each brand has on revenue, and that's something that most companies do. If they have different brands and different products, they tell you how much of that portion is based on revenue. Even though they don't have to, I think just that openness and that transparency helps investors feel more confident for the company, right? So I know carbonated power brands decreased by 16.2%, but I also know carbonated soft drinks increased by 3.6%. But I mean, I need to know what's that actual value of how much these power brands, and it's something I didn't see in their 10Q report or the 10K report, which is pretty unheard of. Another thing I don't like about them is in their public slide, they show quarter to quarter results. They showed quarter one to quarter four of last year, opposed to year. And I'm pretty sure they did this because if we looked at their quarter to quarter results, they had better results shown, opposed to looking at year to year where they have a huge decline. And again, this transparency is more of a leadership type thing. And when I invest in a company, I definitely like to and leadership is one of the important things when I look at it, right? Because I feel if you have a strong leadership, you definitely can have a strong company, and they can turn things around if things look south, if things look bad. But when I feel like this leadership is trying to just make themselves look better, and that's something I'm not a huge fan on. So initial impressions of the companies based on their 10Q report and their investor slides are not good for me. But I still have an open mind, and let's see what's going on. So next we're gonna take a look at their shareholder return. I know a lot of people talk that this company has a massive buyback, and it also has a nice dividend. So the company did pay a special cash dividend on common stocks for $2.90 per share on January 29, 2019. That's actually a pretty healthy dividend, if I may say so. And the last time they paid a dividend was in August 4th, 2017, and before that was January 27, 2017. So here, if we take a look at my quick charts, the one with the purple is dividends, and we can see dividends are pretty spread out over time. These are based on quarters, and you can see they're spread out over time. So this means that this company does not pay a constant dividend. It's just a dividend when it has plenty of cash flow to do that. And I don't think that's a healthy shareholder return. So it's just something to note, right? It does have a nice healthy dividend when it pays dividends, but it's not a constant thing. We can see, like they said, the last one was January 29, 2019. They haven't announced anything at the moment. And the one before that was the last one was August 4th, 2017. So almost 2 years apart. Another thing I hear a lot of people talking is that this company has a strong buyback program, and they do mention this on their 10K report. They say that the company is authorized under stock buyback program to repurchase 1.6 million shares of common stock. As of April 27, 2019, about 500,000 shares were purchased under the program. and there's still about 1 million shares left to buy back. But they also say this: no shares of common stocks have been repurchased during the last 3 fiscal years. So even though they have a buyback program, they have not bought a share in the past 3 years. So why do they have this buyback program? I think it's just another quick way to tell for investors that are just doing a quick read to see that, hey, this company is doing some form of shareholder return. But it's been over 3 years that this company has bought back any form of shares. And we can see here in my orange, right here, you can see in my orange chart that this actually company has been issuing more shares in the past few quarters, and most likely these are shares through leadership selling or leadership compensation, employee compensations of that sort. Because here we can see right there is a nice amount of issuance on equity share. So for that reason, right, another point for Darth Bear. I mean, this company, if you take a look at it from a far point of view, you might think this company has strong shareholder return. But if you take a look at it very detailed quarter, we can see it's not as strong as it turns out, as it seems to be. So the next thing we're going to take a look at is the companies that this company is able to take out $100 million in loans with this credit facility. They call it the credit facility loan. So this company is approved up to $100 million. At the moment, at July 27, 2019, this company has only borrowed $3.2 million of that $100 million. And that's the company's total debt outside of current liabilities and rental leases for real estate and equipment. And that's actually a pretty good thing to see, right? This company does not have any long-term debt outside of leases and equipment. And for that reason, I'm going to have to give a point to Bull Solo. Next, we're going to take a look at outlook based on analysis. So here we can see that for this year of April 2020, this company is expected to have earnings per share of $2.48. For April 2021, next year, this company is expected to have $2.52. So there is small growth going on in this company, but it's pretty small. If we take a look at revenue estimates for this year, this company is expected to make $958 million compared to $968 million the next year. So again, we see this growth. So we see an increase in both earnings per share and revenue. And for that reason, I'm also going to have to give another point to Bull Solo. So even though Darth Bear came off the bat giving us some first points at the first few slides, we can see that Bull Solo is still here and getting some points. One thing though, this company has a PE ratio of 17.2%. If we take a look at April 2021 earnings per share, and to me that's actually a pretty high earnings per share for forward PE based on such a small growth for the company, right? This company is only going to grow 4 cents earnings per share in the year, and it's only going to get an extra $10 million of revenue growth. That's what's expected. And for the company to have such a high forward PE ratio, I know investors here, they're telling me that this is telling me for a company to have this high of a forward PE ratio is telling me that one thing: since there is no growth in this company and it's a small company, it tells me that investors are anticipating or are paying the extra forward PE ratio to that there might be a buyback for this company. And we can see it here right there. They are anticipating some form of buyback or some form of crazy news that will allow them to pay the 17.2 PE forward PE ratio. So what would I value it at? At the moment, I definitely do not have all the information where I would like to put a value at. I did like one thing. I did like that this company has no heavy long-term debt. But like I mentioned, I was not a fan of how the leadership is running the shows for the company, right? It seems pretty sketchy how they run their 10Q report, their 10K report, and how they show off their investor slides. So right now, I do have a little bitter taste in my mouth for FIZZ, but we will have to check next episode. In next episode, I will take a look at their financial numbers and take a heavy look at the revenue, their total assets, their cash flow, and all the information compared to past quarters. And that will help me determine a better number of what I would value this company. So I hope you guys enjoyed the episode. Let me know what you guys think. See you tomorrow when I post this video. Take care. Have a good night.